Happy Tuesday. Sorry, I had to think for a minute. I hope everybody's doing well. Hope everybody's day is going okay. Bit of a rough ride depending on what you own today in terms of the markets, bouncing around a bit. And unfortunately, I kind of think that's going to continue until the government gets back in session. If I saw correctly, today actually tied the longest span of the government being out of session or in this landlock when we go past the budget. Um, and interestingly enough, the next longest time was when the Trump administration was in office last time. So, unfortunately, I think the markets continue to weaken as the government shutdown continues until things work themselves out and they go back in. And then I think the market goes right back up. Now, that's just my opinion. And to get it all out of the way, nothing that we talk about in the live today is financial advice. I am not a financial advisor. Please don't listen to me when making your financial decisions. Do your own research. Reach out to a financial advisor because, as you guys know, what your goals are and my goals are, of course, are going to be different no matter what. So, anyway, I see there's a couple of you. Feel free to chime in at any time as people are getting more used to the lives. I'm just going to chat a bit, but I'm more than happy to answer questions. It's kind of a goal, and I'm hoping more people get involved and we get a little interaction because I like the platform. I think it's super cool. And hopefully the microphone's working okay and you guys hear me all right. Now, that being said, I was super excited about earnings from HIMS, and the stock did pretty much nothing. It was a bit of a dud of earnings. But when I looked through it, it actually makes me more excited about the company. They're growing at a really good pace. Their margins are phenomenal. So I really see potential in HIMS. So I'm happy to have the position and stick with the company for a while. I was a little surprised, earnings missed, but even with the miss, when I look at their growth rate and everything else, and I also feel like some of the problems with the what's the name of those, Ozempic and stuff. The Sorry, I'm having a bit of a brain fart, but the hiccup that they had with the weight loss drugs, it seems like they're in discussions with Novo Nordisk to not just do the shots, but possibly their pill that they're working on, which will help increase the earnings going forward. So I was a little surprised not to see the stock act more favorably, especially because it sold off pretty good going into the earnings, which maybe that's why when it missed, it didn't sell off even worse. Maybe that was already priced in or to be expected. But I do like the company. I'm going to stick with it. I'm going to continue selling options on it. I would have liked to have seen it rally a bit more. And I'm not sure if that was muted a bit just because of the market having a tough day today in general. I also think Meta is getting to an extremely attractive area here. And as I mentioned in one of my videos, United Health is looking super attractive to me again. And to me, these are all great companies getting discounted. Again, with the government being on shutdown, I think the pricing could get more attractive. And I've transitioned in my trading account to more of selling puts than just buying into stocks so that I can pick a price that I'm content buying something at, get a premium to sell the put in it, and if it's below that strike price at the time of expiration, well, then I end up buying the shares at the price that I put in. There's a few risks with that. Obviously, it can blow right through your level of the put that you sold. But to be fair, if it's a company you're happy to buy and you don't mind getting long there, and you would have either way, whether you did it with the puts or not, then really it should be okay, even if it blows through your strike price. On top of that, the real risk, in my opinion, is if I'm willing to buy stock X at $100 and I sell a put for a month out or whenever it is, there is a possibility that it drops down to $98, and by the time of the expiration of the put, that it expires not in the money, and I collect the premium, but I don't end up buying the stock, missing that opportunity where I would have bought it at $100 had I just put the order in and not sold the put. So there's a risk to that as well. But either way, like, I'm content doing that, especially when I do the math of when I annualize the returns of selling puts. It's an attractive strategy to me. And in my trading account, not only that, I will reverse and sell calls on the positions I get filled in and just continue to collect premiums the best I can. As I've been teaching my son the strategy, I've been watching his account do quite well, which is kind of why I thought, this does work pretty well. I'm going to implement it in the trading account a little bit more. Pay less attention throughout the week as to where stocks are bouncing around, and not worry about it until the week's over, and then adjust accordingly depending on if I got assigned some shares of something or if I sold something, and then reverse and either sell puts if I got taken on some calls, or sell some calls if I got assigned shares or something, and potentially sell more puts if nothing happened. So that's what I started doing in the trading account. I did, before doing the video today, I started kind of rummaging through some of the videos on YouTube, and I saw one for these yield max funds, and I wanted to get into that a little bit again too, because I really hate these funds, and there's a few reasons I hate these funds. Nothing bothers me about what they actually do. What bothers me the most is the sales pitch on them, because I think they're aiming towards retirees who haven't quite saved enough to be able to retire, who see the yield that it pays and get over attractive and think, oh, look, even if I only have X dollars, if I put it into this fund and get a 70% return annually, man, that's plenty to live on. The problem is it's super unrealistic, and you can't really rely on those premiums. Now, to really reiterate it, that is not financial advice. You guys do you. If it fits what you want to do, by all means, go ahead and invest in them. But here's the real problem with them, because they really are unlikely to get you the return that the yield says. The yield is actually not a dividend, it's a distribution. And some of the time, it's just your own money being given back to you. And when they do that, you might see the share price of the stock drop despite you receiving this wonderful payment. And here's how they work. They buy a stock synthetically. And what does synthetically mean? Well, instead of buying the stock, they'll buy a call and sell a put. What's the difference? What are you saying? That gets really confusing. So if you look at an $100 stock, right, and you have to buy 100 shares in order to sell a call against it and collect a premium, that's going to cost you $10,000 out of pocket. Instead of doing that, if somebody bought a call and sold a put, and that's at the money, potentially both the call and the put are around the same dollar value. So you may not actually put any money out of pocket. Now, if you're a big company and you're doing this strategy, your clearinghouse, or what you guys think of as your brokerage firm, is going to require a certain percentage of margin. So maybe instead of having to come up with the 10 grand, they need to only come up with 25% of what it would have been had they bought the shares, because that's what the clearinghouse sees as the risk of the stock moving and then potentially having to cover losses if it moves against them. So there's a couple advantages to this. One being they can take the other 7,500 if they literally did it just one time, because that was what they would have if they bought the stock, and put it in a treasury or something else that pays a little bit of a dividend and collect some yield on the cash in the portfolio. The other thing it does is it allows them to margin the position. Maybe they're buying 4 of these instead of just one. More risk, leverage, things that may or may not be so good. So why buy the call and sell the put? What did you just do? The reason it's called synthetically long is because no matter what happens with the stock, unless it closes at exactly 100, you're going to end up long the stock. If you've bought the call and the stock goes higher, by being long the call, it gives you the right to buy the stock at $100 a share, which of course you're going to do because the stock is higher. If you've sold a put, now I'll start with explaining buying a put and then just say it's the opposite, because sometimes this gets confusing for people. If you buy a put it gives you the right to sell a stock at a strike price on a certain date. So when you sell the put, it's the opposite. Since the other person is going to have the right to sell the shares if it gets below the strike price at the date of expiration, if they exercise that right, it is going to force you as the put seller to buy the 100 shares at that price. So same thing, if you bought the call at the $100 call and you sold an $100 put, no matter which way the stock goes, you end up buying 100 shares at 100. These funds then sell the covered call against the long call. And generally, they're doing it about 5% above the strike price. So maybe they've bought an $100 call, sold an $100 put, and they also sell a 105 call. And they do weeklies for these and collected a premium for the $105 call that they sell, which is kind of like what a dividend might be and what they're using it for, but what they call the distribution. Now, here's the problem with the funds and the risk that nobody sees. If the stock shoots higher, you've limited yourself to that $105 price. If it goes to 120, you've sold that $105 call. You're only making the $5 plus the premium for selling the call, and that's best case scenario. On the flip side, if it drops to $80, the same $20 move, you're buying it at $100. You are still collecting the premium for selling the $105 call, but you're going to lose the full $20 on the downside. So you limit your upside potential with the full risk of the downside potential. And what ends up happening, what bothers me is not the fund, because anybody who understands what they're doing and is totally happy with it and doesn't mind taking on that type of risk, by all means, like anything is just fine. Strategies have good and bad to them. This is not the worst strategy in the world. It is not anything that I have an issue with. What I have an issue with on it is selling it to retirees, making them think it's something safe that gives a dividend or a distribution that they can rely on to live on. And if you listen to the CEO when he does interviews, he kind of talks about that distribution, but then he double talks and he starts talking about how the real way to get a return is to reinvest those distributions in order to get an actual return. So wait a second. You're selling it to retirees, letting them know that they're getting a better distribution than buying something big and boring that doesn't pay a high dividend yield, so that they can have enough money to live on when they might not have saved enough. And in the same breath, following up with, well, of course the stock price is going to go down and you're going to lose on your net asset value. And the way to stop that is to reinvest those dividends. So, which is it? Is it a high dividend that I can rely on in terms of retirement to be able to pay my bills if I hadn't saved enough? Or is it just another avenue of an investment that I have to reinvest those distributions, or I'm going to lose my money and those distributions are going to continue to dwindle? And the real answer is it's probably number two. These are high risk funds. And the part that irks me is selling it to retirees with the sales pitch of you can live on these distributions because it's better than putting it in. I'm making up. I don't know what Procter and Gamble gets, but putting it in P&G and getting a 2.5% return, because then you're going to need millions of dollars to retire. Unfortunately, that might be true. You just might need more than you've saved. And telling people to take on these risky funds and implying that they can rely on those distributions is just a sleazy used car salesmanship. And that's why I don't like the yield max funds. I don't know if any of you use them, if you're happy with them, if you've had good success. The people who I've watched their videos who have good success with these, they tend to actually trade them. They don't just own them. They are not a set it and forget it type of investment. They are something that they're very active about. They know when the distributions are. They get used to the ups and downs that the product has, and they're not simply investing in it and getting a return. And then some of them are doing exactly what he says and reinvesting, especially the young people, with an attitude of if it builds up big enough, I'll get a big enough return. Again, Maybe it's a good investment, maybe it isn't. That's up to you guys. But my understanding is almost all of them, if you just buy the underlying equity, you end up outperforming the what the yield max fund does in terms of returns. So I don't understand the advantage. If you have no issue with that type of risk, if you want to own Tesla, why wouldn't you buy Tesla if it outperforms? Or if Misty doesn't do as well as MicroStrategies, or I guess it's Strategy now, why wouldn't you just buy Strategy or any of them? I'm not picking one or the other that I think is the best. I'm just using them as examples because, again, my understanding is you end up better off owning the underlying than owning these funds. So it makes no sense to me to invest in them. All right, so Wheat Candle has my first question. Thanks for putting something out there. Adam, do you think the rotation into healthcare as a defensive play is close? What do you mean by close? Do I think it's over, or do I think it's do I think it's close? Do I think people are going to? I personally have been rotating into it. Now, I started when United Health had that correction. Well, actually, I've owned Pfizer for a long time. And actually, I'll talk about Pfizer and their earnings a bit too, because I found it really interesting. But yes, I do. And I think it's actually going on. And I think these things are so undervalued. It may last a while during the Trump administration just because RFK or whoever trying to change things. I think it leaves a little bit of cloudiness on where they're going to end up as time moves on. But I find in the end that these things work themselves out. These companies have a good stronghold of other constituents who they reach out to. I guess it's not constituents, but the Congress and senators who they're talking to about um, their goals for healthcare. And either way, this administration is going to be out in 3 years, and a new one's going to come in, and whatever goes on is likely to change. But to me, when I look at healthcare, they look so undervalued and such a good opportunity that I, I really like it, and I have been rotating into it. I've been rotating more than I would have expected because to me it looks like such a good value currently. I've bought Pfizer, Bristol Myers, United Health, and I've been looking at others as well. Um, and rotating out of growth because I'm getting old. Like, I don't know where you guys are in your life. Thanks for the comment, Dave N4544. I appreciate same type of you. But Wheat Candle, to be fair, I'm 53 years old, getting closer to retirement. And when I look at 5 and 6 and 7% dividends in some of this stuff, that's really attractive to me. And I was fortunate to pick up, Amazon and Google and Meta years ago, and have been lucky with those that I don't care if they keep going higher and I miss out on some returns. It's getting to the point that it's easier for me to have a dividend coming in. Now, in terms of Pfizer, because I know I said I'd talk about it and you said you'd love to hear it, I'm a little shocked that the stock hasn't reacted today better than it did. And I feel like there's something that I'm missing. Excuse me. Because this is like the third or fourth quarter that not only have they beaten, like they have crushed it. So when I see their earnings and they just have destroyed it and they continue to just crush it, and the stock has bounced around and really gone nowhere. If I'm doing, like, I thought they said they had 87% earnings, and I didn't see the revenue, but I know that grew as well. 87 cents. If I took this quarter's, and maybe there's a reason this quarter is more elevated than others, you're talking about like 340 a year. How is it not back in the 30s? Like even an 8 or 9% PE, if I think of what this quarter was, unless they just have a ton of debt on the books or something that I'm just missing and need to dig a little bit deeper. And again, it's like the third or fourth quarter in a row that they've really crushed it. And the stock, last time it really shot up and then fell back down. And same with the time before. But I'm hoping this time it just takes longer and then starts to trickle higher. Uh, it's not like nobody pays attention to Pfizer, and Bristol Myers had decent earnings as well. And either way, yes, I think you'll see the rotation into it. I think that we all need healthcare. It's not really going anywhere. And in terms of AI and that being the buzzword and disrupting this or that, my guess is no matter what goes on in the world with technology, like they're going to do just fine. If anything, it'll help all of their businesses or whomever has the best system to help push their earnings and figure out the best strategy for direction and everything else. But I love these companies. I have a pretty big position in Pfizer and a pretty big position in Bristol Myers, and I was fortunate to pick up the United Health on the pullback, and it's growing into a decent position as well. Um, and really, I thought this last fall for United Health, it was really I bought a little bit and sold a put, and I sold a call on it. So, which is what I don't know if you caught later was in the beginning. I've been doing a little bit more in my trading account of trading the options than just trading the stocks because I can put a price on a put, and if I get filled on the shares, I'll collect them, and then I'll reverse and sell a call. In fact, today with United Health, I was short a 360 call that would expire on Friday. I covered that and sold the same strike price a couple weeks out for a little bit more of a premium, figuring I'm happy to sell it back out there. Now, I understand when I do that stuff, if you guys are I own some United Health in my retirement account that I plan to just own. Like I feel like it could be a CrowdStrike type moment where it totally got out of favor and oversold and over the next couple of years just goes right back up. Like I don't really see anything wrong with the company other than what's going on with the Department of Justice. And my thought is if the politicians are buying it, the insiders at the company are buying it, as well as Warren Buffett, that somebody somewhere does not think that Department of Justice overhang is as bad as the media makes it out to be. And in time when it plays out, either they're going to get a fine or it's going to come out that it really wasn't such a big deal and they're going to be allowed to move on. Just my opinion. I mean, I'm wrong about a lot of things. I just Warren Buffett really knows the healthcare space, and for them to buy into it, he had to have talked to somebody and had a little bit of comfort that this is not a major problem. And then again, my understanding is even the politicians are buying the company. If the people in our Senate and Congress were buying it, I just don't see it getting penalized. So anyway, I love the healthcare space. I just think it's one of those things that'll take time, and they're companies that I'm not expecting them to be high flyers or bounce around a whole lot. I mean, I think I probably owned Pfizer for 4 or 5 years from $27 or $28, and just happy to keep collecting the dividend. And I think that'll be the case going forward, unless obviously something changes. I mean, I don't know. I can sit a while. Even I've talked about in my videos Target, which everybody hates. And generally, when people hate it, I like it even more. Target was below $90 at least earlier today, and I see that as like a really good opportunity. And maybe they become a Sears or something that just sucks ass over the next few years. But I, they seem like they do just fine. I pull into the parking lots and there's plenty of people, and I'm sure they're doing more and more online as well. Um, so, do I like Berkshire at these levels? Slightly in the money, wondering whether to invest my position or trade it. So, I don't follow Berkshire too carefully. Um, it's not a fund that I'm interested in, but when I make my little disclaimer, really somebody should make their own decisions on it. Just because I don't really love Berkshire doesn't mean somebody else shouldn't. But I have no affinity to it. And when I've looked at his like from my perspective, he is a smart guy who has a good knack for knowing when a company is undervalued and mismanaged, and he can pick it up at a good price, re start getting into the management, and really help to grow the business. That being said, he's had two great trades between Coca-Cola and Apple. And outside of that, I mean, if you look at the history over a really long time, he's outperformed the market by a little, which is phenomenal because it's very hard to outperform. But I don't think he's done anything that you or I can't do either. When a good company is in bad favor, I see it as good opportunity. I mean, right now I'm beginning to eyeball Chipotle because my timeline is kind of like his. If I'm looking 10 or 20 years out, not super concerned that they had a bad quarter or two. I think it's helped the stock fall that Brian Nickel is no longer the CEO, but I also think he probably transitioned out because they had matured and grown to a size that it's hard to continue to grow at a huge pace. But McDonald's has done incredible over the last 20 years. There's no reason for me to think that Chipotle is going to struggle for 10 or 20 years. Maybe they have a bad year, maybe it's a bad 2, 3, or 4. I mean, Starbucks is struggling probably going on 3 or 4 years. But I think these companies will do essentially what inflation does and go up. And maybe Chipotle eventually offers, forgive me, anyway, maybe they'll start offering a dividend too to get out of the basement or their difficulties that they're having now. But in terms of Berkshire in particular, especially since other than the companies that Berkshire owns the companies that they've sold out of a lot of positions and they're just waiting. My attitude is I could sit on the sidelines in CDs and treasuries and wait as well. So I have no strong desire to put money in there. Now, that being said, I think the fact that they have a lot of cash on the sidelines gives some security. And if there becomes an opportunity, I'm sure they'll step into something. But I think he also announced that he's retiring, so you're really betting on the other managers who've learned from him and they might do great. But I kind of wonder when he passes if we're going to see a pullback in the price of Berkshire. Just I I don't know one way or another because I'm sure people have an expectation that it's going to happen at some point. So maybe it's a non-event, but I do feel like some people will simply sell because if he's not around, they won't want to own it. But there's nothing wrong with Berkshire, so I don't want to pick on it too much. It's as good as anything else. Me personally, if I was looking to be in a fund, I would probably be in VOO. I mean, my discussions with my wife and son are like, forgive my sick, twisted brain, but if something happens to me and I die, sell everything and put it like 70 or 80% in VOO and the 20 or 30% in QQQM and don't even worry about it. To the point that I've made them like repeat VOO and QQQM. My wife could care less about this stuff. It makes like she doesn't pay attention. And I think that diversifies you. You own the S&P 500 and you own the Qs, so you get a little bit of boost of technology, and then you'll do whatever the markets do. You'll go up and you'll go down along with them. They pay a small dividend, and then you don't have to pay attention to it. Not only that, you then don't have to pay somebody else to pay attention either. Who, what do they say? Like 70 or 80% of the advisors do worse than the S&P 500. I thought it was like 90 or something, but I think I Googled it and it said 80 or set high 70s. But either way, you have a high probability of having somebody help you who's going to underperform. As long as you're not going to do something stupid and trade it and get in or out or whatever it is you might do, if you're really good about just putting the money away and leaving it, might as well just put it in VOO and not even think about it and be done. That's my thought when it comes to a fund, and like I said, to overanalyze that. But again, nothing wrong with it. They've done real well over the years. Just my thoughts on it. I don't know, what stocks do you guys watch? The ones that have looked attractive to me lately are similar. The healthcare one, Starbucks, getting under $80 today starts to look attractive to me, but it's just been a dog for a long time. I don't know when they'll catch themselves. Um, Again, Target I talk about all the time because it's been a dog for a while. And then I've started with Conagra, but mainly because the dividend, and I don't see them being real interesting. But the problem with a few of them is with the government shutdown. What I recognize is, like, I just thinking about the SNAP benefits. There was a stat that they said 40 million people receive SNAP. 40 million. So that's over 10% of our population gets the EBT cards or whatever they are to be able to buy groceries. Well, that's not only just them being able to buy food for them and their families, but that's a huge percentage of the GDP if you think about it, because that's all the money going to buy those things, going to companies like Johnson and Johnson and Conagra and Whole Foods and Albertsons and Smiths and Ralphs and all the others. So you're talking about 40 million people getting SNAP benefits that are not going to get it. That is going to slow the economy down, as the Fed is no longer, or at least they're hinting that they might pause on rate cutting because they don't have data. Well, they're smart enough to know that if the government is shut down and all this, the salaries and SNAP and all the other things that are no longer having money flow through it, means that the GDP is going to be down and we're going to continue to slow. So saying that it's like a car driving through the fog, so you have to kind of wait until you have the data, might be a little bit political to try to push everybody back in, instead of recognizing that, Dodo, of course they're still slowing. You could absolutely keep cutting because all that money isn't being spent. Anyway, that's a tangent, but it's going to impact earnings for sure. Um, Especially food companies, and Conagra has been one of my favorites lately, especially trading options on it. Do you only buy stocks that are trading above their 30-day moving average on a weekly chart, or do you like to buy the deep value for a balanced trade? There is no specific that I look for, because I will buy stocks that are making new highs. If I think it'll continue, I will buy stocks when they're making new lows. If I think that it's overdone, and yeah, I'll look at a chart and see where it lays on the chart as well. So it's not like I have a specific that I'm looking for where they are in terms of their 30-day moving average. I am definitely much more of Peter Lynch, where if I think a good company is a good company, because I think a lot of the data we get is unclear or inaccurate, and you can do all the analyzing in terms of earnings that you want, and we don't have the right data because the people who are running the company, they're accounting firms, are very smart and very talented about making things look the way they want them to look, no matter what's going on, or potentially hiding things if there are problems, or hiding things to try to make it not look as good as they pick up the stock. So I just try to stick with companies who I understand what they do for the most part. And my time horizon really is 5 years or longer for more than 80 or 90% of my investments, because I think it's very difficult to trade. I still enjoy it. It's why I have the trading account. I do find that the options work, and I do just fine with those. But for the most part, the stuff that I've just owned for 5 or 10 or 20 years is really what tends to do the best, as long as I stick with you know, it doesn't have to be the greatest company. And I've told the story, I don't know if you guys have heard it, a bunch of times, about receiving a gift from my grandfather when I was a junior in high school, and being wrong about three of the four companies that I put money into. that they went out of business, but the one that didn't go out of business did well enough that the overall returns on the total investment is still really good. And that would have been just doing nothing with the just putting it into four companies that were all just basic, Home Depot type of companies. And it works out just fine. So I think time in the market is more important than timing the market. And I really like, so what I call in some of my videos my set it and forget it account is a total old fashioned account. I cannot go online and make trades. I have to pick up the phone and call the company and go through some hoops to be able to do anything. I can't get a check. I can't do anything. Well, the reason for that is to stop me from being me. I was a commodities trader for a long time, so I tend to trade too often. And if I have online access, I'll trade. But I also know that companies just grow over time. And I have about 30 tickers that I'm totally comfortable with the companies I have, and I just leave it alone and let them be. Um, the largest few, if you guys care, are Meta, Google, Amazon, Chevron, Starbucks, Microsoft, and then Intuitive Surgical, but really because I bought it cheap and it's done well. And but most of it is just stuff like I'll put a small amount in something like Shopify years ago, but I've owned Shopify for 4 or 5 years, something like that. Um, and I just leave it alone. I don't pay attention to these things. I could care less that it's down today on earnings. I notice because I know I have it in the stock, so when I in the account. So when I hear the name, I might pick my head up and kind of look at CNBC and see what's going on. But it's kind of like just noise in the background, because really what I hope is that's the stuff that goes to my like. I hope I never actually need those funds. I hope that I hope I live another 30 or 40 years and it continues to grow. And then it goes to my wife and my kid, and it's enough that they can just put it in dividends or something simple and be able to utilize it to live off of. Now, in the videos, I more often talk about the things that I'm trading, excuse me, because it's very boring for me to talk about I own Chevron. Like who cares? Like that doesn't boring. Nobody's real interested a bit into that. So I'll talk about the stuff I'm trading. I'll talk about hymns. I'll talk about the calls and the puts that I'm selling on Conagra, which is really interesting because all Conagra has done is drift lower, but meanwhile it's done just fine with the premiums I've collected 10, 15 cents at a time. I mean, it's like pennies, but it's kind of funny when I think about the stock is probably $3 against me or close to it on average. But meanwhile, over the past 4 months, I've collected enough in premiums that I think I'm down a couple $100 instead of what should be a few thousand. So it's really neat. And if it reverses and I get taken on the calls that I sold, I'll actually do quite well on it. And in the meantime, it's this totally boring, nothing company that never really makes me nervous because it doesn't go like day to day, it's up 10 or 20 cents as opposed to, hymns, which is all over the place and can make me really nervous and gives me a heart attack. Um, Even Verizon, I started doing the same thing. The only problem with Verizon is the volatility index is so low. Uh, when I've done the math of what the options get, it gives a boost to owning the stock and getting the dividend, but it doesn't it it isn't as lucrative as Conagra is. It's interesting. I don't know why Conagra is, and I'm beginning to do a little with Pfizer and Bristol. Like I'm picking very boring stocks to sell both puts and calls on and collect those premiums and make a few dollars, whether it's weekly or monthly, and just noticing that that really adds up and you're able to get maybe a 20% annual yield on companies that don't scare me with big market moves. Um, been buying a few REITs and utilities in Canada. Yeah, David, like me too. That's the stuff I've been looking at. I started eyeballing, not in Canada, but VICI, which is the Las Vegas. I just worry that they're a little too pointed since it's just Las Vegas real estate. But I've been looking at some of that too for the same reason. Um, my brother, who is a financial advisor for just, I don't know if I have to disclose or just anyway. He always makes fun of me for dividends because his attitude, and I get it, and I know deep down he's right that if you own the best companies, you will do the best. And just because a company pays a dividend doesn't mean they make enough to pay the dividend and everything else. But I'm getting to where I'm so less concerned about performance and doing as well as the market or whatever else, and much more concerned about maybe they're not safer, but having a little bit security in some of these older, bigger, more established companies that maybe they're not growing as fast. But what I like about the dividend, and this guy Gen X dividend investor talks about this stuff a lot, which is I don't have to think about like the dividend just automatically happens. I don't have to pay attention and sell 3 shares of this or 5 of that to get the equivalent of a dividend. I don't have to slowly dwindle my percentage of the company I own, um, and it just automatically happens. So if I end up owning stocks that don't grow as fast as Meta and Google and Amazon, which, like I said, are 3 of the largest positions I have. And maybe I slowly transition into things like REITs and utilities and healthcare that pay a decent dividend, and I lose out on some potential upside growth. I think as I'm getting older, that's just fine with me. I don't mind losing out on the growth potential to have the steady income in because at this stage, I'm getting to the point that I'd rather rely on those dividends and not pay attention so much and be able to pay our bills and spend time with my wife and son because forgive getting off the investment discussion. Life goes by so fast and the time with friends and family, like by the time you blink, like I'm worried that I'm going to be 70 and unable to even do the things that we're doing right now. And I don't want to miss out on opportunities with my family and the time because I'm still trying to pay too much attention and worrying about the growth in the account. I would rather slow down a bit, hang out with my son. Like I wake up in the mornings, I make him breakfast. He's old enough, he can do it on his own. I can make him do it, but I'll pick him up from school and get to spend time with him because he's 14, he's 15. Like I still get to spend time with him, and I know in another year or so he's going to have his own license and he's going to be out the door. And to me, the value that I get from that stuff, like if I make a little bit less and the account doesn't grow as much and we're living off dividends, but I get to spend more time with them. Like I'm all in on making less and having the security and being with them and not anyway. So I've been pushing into REITs and utilities as well as healthcare because I'm all for rotating out of the riskier stuff into things that'll pay the bills. So all right. Any other questions before I head out and have a little snack with my wife? And oh, okay. Cool, nice. I don't know if we're same age. Like I've got like I'm 53, which is still young, I guess. But okay, so here's part of like the past few years, the past 4 years, we've been taking these really long summer vacations, and for the same type of reason. Like we go away for like 6 or 8 weeks together, and we went to Asia, then we went to Europe, then we went to Asia again this summer, and I can tell my son's getting to the age that he does. Okay, cool. That hanging out with mom and dad while he enjoys it, maybe 6 to 8 weeks might be a little long because he wants to play on the computer with his friends and he wants to do stuff like. And I get it. I was that age. It's not a judgment, but I know the time is short and we're only going to get so much time, and he's going to remember those trips. But the point is, oh fuck, the plane ride and the other stuff, like not only that, like I'm a little bit heavy and whatever else, my back is hurting, my knees start to hurt. There are things in my life that like I know my parents used to say to me that it didn't really click So what I recognize now is, oh my God, another 20 years, it's not going to be so easy to take a flight for 8 hours or whatever it is. So I'm really pushing to try to get that time in now before I'm too old where it's harder and harder to do. So that's all part of the rotation out of the other stuff. Even if we had to like live a little bit smaller in some ways and not do so, like I've been going to the office way less. My income has dropped more than 50%, but not like I'm sure I could put the time in and push and try to drive business, but everything will be fine. And the, I don't want to get to that age that my body just hurts and I can't do the stuff with my family that I'm enjoying doing now. So so yeah, I've been doing the same stuff and rotating into boring old REITs and dividend stuff that I really don't expect to increase the portfolio value, but should be able to rely on the dividends coming in unless something unexpected happens. And if the values go down, and like I have this discussion with my buddy Steve, that I'll just say this and then probably call it a day. So if you have questions, anybody just ask while I'm rambling about this. I'll say like we'll talk about Verizon and I'll make a comment of I'm happy to get the 6.5 or 6.75 yield. That's a great yield, and I'm not super concerned. He's like, but what if the stock price drops to $33 a share? And I'm trying to explain that so long as I get the dividend, I really don't care. Like if that keeps coming, what's the difference to me what the actual value is? He's like, yeah, but if it drops, they may have to cut the dividend. Oh, okay, well that's different. Your question was, what if the stock price drops? Well, if that's an isolated event and they continue to make those payments and that's what I bought it for, what's the difference? Like if I'm getting $100 every quarter and that's what I need and to pay the cell phone bill or whatever it is, as long as that check comes in, it really doesn't bother me if the stock price goes down. Whereas if I own Amazon that doesn't really pay a dividend and the stock price goes down, in my brain the way it works is, well shit, now when I sell Amazon, that's less money that I can put into the dividend stuff to pay the bills. So that's why I'm rotating in, is all of that stuff. No, don't know that that was what you asked. Anyway, guys, have a great day. I'm going to call it a day. I'll probably just post regular videos, but I'm going to try to stick to Tuesday at 11 at least. I might do other lives, but Tuesday at 11 Pacific time for sure. So have a great day, everyone.